Are you cruising into retirement or are you on a sinking ship? Hopefully you're on that cruise ship. Show's called Your Money, Your Wealth. Joe Anderson here, president of Pure Financial Advisors, with the big man, Big Al Clopine, sitting right over there. Alan, you ever been on a cruise?
Probably half a dozen times.
All right, we're going to cruise right into retirement because unfortunately, a lot of people need a life vest in regards to their overall financial plan. 86% believe retirement plan is important. How many people actually plan? 42% feel prepared for retirement. There's always this disconnect. Let's get you on course, folks. That's today's Financial Focus. We always have to have a doom and gloom stat here. 46% of Americans, they're sinking, Big Al. Zero retirement savings. This is I wonder if they're including like children under the age of 5.
Could be. If you count my sons in there, they could be.
Yeah. Here's the fact of the matter is that we're ill prepared for overall retirement. If you want to get on that fancy cruise ship to retirement, let's bring in the captain.
Wow, Captain Big Al, I'll take it. What the heck? So we're trying to cruise into retirement. So there's 3 steps, right? We got to get all aboard. We got to prepare. We got to plan. We got to figure this stuff out. What are we doing? What do we need to improve on? Then we need to be aware of how we can become seasick, right? Problems, inclement weather along the way. What are things that we need to watch out for, be prepared for? And then finally, let's move into retirement. Let's cruise into a great retirement.
Well, let's get all aboard, folks. First off is you got to kind of start thinking about what type of fixed income that you're going to have in retirement, all right? So let's talk about Social Security. So a lot of times people think that Social Security is going to cover a lot of my living expenses in retirement. That's one camp. Another camp thinks that Social Security is not even going to be there. So let's kind of split the middle here. But let's say if your income today is around $50,000, okay, your Social Security benefit will probably cover 35% of that income. But as your income increases, right, then the percentage of that Social Security that's going to match that income goes down drastically.
Well, it does, and that's by design, right? I mean, it was there so that none of us are in the absolute poorhouse, right? That we can have a place to live and food to eat, hopefully. So it's geared towards those that make less income and less savings. So just be aware.
So let's look at cash flow. So income. So let's say if you have a pension, if you're lucky enough to have a pension or some sort of annuity payment, then you add in your Social Security payment. And then you have investments. So you might need to take some dollars from that overall nest egg. Is it 1%, 3%, 4% of the overall nest egg? And then you look at other income. Maybe you have real estate income. Maybe you're working part-time. But this is the monthly income or cash flow, cash inflows. Add that up. That's your income. Now you have the bottom half of the ledger is that you have essential expenses and discretionary, right? So this is the must-haves, and these are the wants. So you can add those two up and look at your total income minus your expenses. That is your cash flow. So this is going to drive all of the investment decisions, your tax decisions, based on these 2 columns here.
Yeah, and I think that's a really good way to look at it when you're close to retiring. Now, let's say you're 47, right? And you want to retire in 20 years at 67. So in this example, we have $55,000 income in 20 years. We've got $144,000 of expenses, not 80. 80 is what it is today. So you have a shortfall of $89,000. So then you got to go to work. You got to figure out how to cover that shortfall in the future.
Yeah, if we go back here, we're looking at monthly cash flow, monthly expenses. So here you're estimating what that cash flow is. So your fixed income, whatever that could be, your Social Security, that could be, right, your pensions, annuities, it could be other income, things of that nature. In this example, we're going to assume it's $55,000, right? It's a guesstimate. But my current spending is 80, so that's the bottom half. So 55's coming in, 80's coming out. I'm going to be short, right? That's why you have a portfolio. And so we're going to figure out what this investment needs to be to cover this shortfall, right? So all of this kind of adds up. So I'm 47, 67, you're doing the math. Hey, $89,000 is the shortfall, inflation adjusted. So if my shortfall is $89,000, Al, how much money do I need?
Well, it's a good question. So we talk about the 4% rule. So basically the 4% rule, how much money do you need to have in investments at that 4% will produce the amount of income. So you can either divide by 4%, but an easier way to do it is to multiply that shortfall by 25. And in this example, right, you get $2.2 million. So that sounds like a pretty big number.
So this $89,000 is what I need from the overall portfolio. So I have my nest egg here. It's all good. This nest egg needs to produce this $89,000. So I need to divide that by 4%, or I can multiply it by 25 as you see here. So 89,000 times 25 is 2.2 million. So this nest egg that I've been saving, this needs to be $2.2 million. 4% of 2.2 million is going to be that 89 grand. So it's like, man, that's a big mountain to climb. What do I need to do? Well, I'm 47, so I got time. That's the good thing. And I got some savings. I got a couple of bucks in my 401k. It's 400,000. So now I need to do some math to figure out how does 400,000 over 20 years turn to 2.2. Well, the math is I need to save about $26,000 a year. If I can't save $26,000 a year, I'm going to have to work longer. If I can't save $26,000 a year, right, I'm going to have to spend less, right? Or I can work a little bit longer, spend a little bit less, and get to your overall goal. A lot of levers that you can pull here, but it's just understanding the math in this dirty scribble is the key to success.
Well, you're right about that. And so a lot of people, when they get to retirement, they haven't quite hit their goal, and that's okay. You can work part-time. A lot of people these days work part-time to generate at least a little income while they're perhaps collecting Social Security after full retirement age, for example. So there's spend less, you downsize, there's all kinds of things you can do.
Looking at your time horizon, as you get closer, right, to your retirement goal, you're going to have to make sure that you're making pivots in the overall portfolio, right? Because some storms might come up, especially as you get closer. So let's say the markets drop 20% and you're all in equity still trying to grow that portfolio. Well, now you're 20% and you're trying to get to this nice little island. Well, you're probably going to have to work a lot more because you have 20% less cash. Okay, so it's just making sure that you're managing your overall investments each year as you get closer to that destination. All right, when we get back, we're gonna talk about stormy seas. What happens if things get a little bit of rockiness on your way to that retirement destination? Don't go anywhere, we'll be right back.
For a limited time only, the Cruising into Retirement Guide is the special offer at yourmoneyyourwealth.com. This free guide is the life vest and compass that will show you how to plot the proper course to cruise into retirement in more detail than Joe and Big Al can cover here on YMYW. Go to yourmoneyyourwealth.com and download this special offer, the Cruising into Retirement Guide, by this Friday.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. We're on a sea cruise, folks, helping you with your retirement goals. Before we see these stormy seas, let's see how you did on the True Pulse question.
The average household retirement account for Americans 65 plus is less than $500,000. True or false? Well, that is true, and Joe, I think you've got the number.
400,000, that's a great start. That number keeps increasing, so that's a good sign. So, Al, let's talk about seasick.
Let's try to avoid getting seasick. It's paying for all the medical costs that you're going to have at 65 and later. So Fidelity does a study every single year to figure out what's the cost for an average couple in medical expenses from 65 on to the rest of life. And right now they've come up with $315,000, which sounds like a lot of money. How does that break down? Well, you can see from the chart there, about 17% is drugs, almost 40% is Medicare, Parts B and D premiums, and then the co-payments, co-insurance, deductibles, that's about 44%. But before you freak out, let's think about this a little bit differently. That equates out to maybe $10,000 or $11,000, $12,000 a year for a couple. So maybe $5,000 or $6,000 per person. Now it's like a little bit more bite-sized than this giant number, which, Joe, I think freaks a lot of people out.
Yeah, I mean, it's like, well, here, if I only have $400,000 in my retirement account and my health is going to cost, my medical costs are going to cost me $300,000, that gives me $100,000 to
rice and beans.
Right, but no, if you break it out here, and it's a few $100s a month, right? right? So, and some of you will need a little bit more in drugs. Some of you might be a little bit less, depending on what your health is. So, 300,000 is kind of the fear factor, but you break it down. Of course, that's why we're here. We want to make sure that you're doing the appropriate planning. Another thing that you got to consider is inflation. Let's say if you have $1 million today, that $1 million purchasing power in 2038, age 85 is half, right? Less than half. So that's why we invest, is just because that, hey, the purchasing power of the dollar may not be the same in 10, 20, 30 years, right? So you have to outpace inflation. So that could be done with CDs, bonds, equities, real estate. But you want to look at, well, what is your spending need? How much is the capital that you currently have? What inflation rate would you like to use? And then making sure that you outpace it.
Yeah, and I think that can be kind of a confusing concept for a lot of people, but maybe think about it this way. So you'll still have the $1 million, right? if you just like put it in a checking account that had zero interest and you didn't spend it, right? But that $1 million is going to buy a lot less, and the reason is because your food will cost double in 25 years. Fuel will cost double. Everything costs double, so that $1 million only buys about half of what it does in today's dollars. Let's
use an example, Al. We'll use that same $1 million, and you want to start creating income from that overall portfolio. So let's say you're 67 years old, you have $1 million, your rate of return roughly 6%. But you cannot forget about inflation, which we just talked about. Let's just assume that inflation is at 3% over the next 10, 20, 30 years. So I'm receiving a 6% rate of return. I have that $1 million, so a lot of times people think, all right, well, if my expected or average rate of return is 6 or 8 or 4, well, that's how much I can pull out. So if I'm going to pull out 6% per year, right, you can see, well, I'm going to run out. I'm going to burn out of cash. And the reason for that is that I'm taking out more. That inflation is kind of eating me up. So if I take out 4%, that's kind of the safe withdrawal rate. You can see here with the 6% growth rate, 3% inflation, I'm still roughly at that $1 million.
Yeah, I think that's a good example, but also be aware, this is just illustration, right? 4% for some of you may be too much, right? 6% may be just fine. It just depends upon a lot of variables like life expectancy, for example, like how your investments do, whether you have better investment income and growth in the first few years than the last few years, does your spending increase? A lot of things. So when we do these charts, just realize this is an illustration, but this is something you kind of have to monitor year by year.
Yeah, good point, because I think the biggest risk that a lot of retirees have is that, A, how much money are they pulling out? And then what does the market or their portfolio do in each of those years? So it's that sequence of returns. So let's say if the market is doing this and you're pulling out a consistent 6 or 4%, I mean, it doesn't matter what you're pulling out. If I'm pulling money out in down markets, right, it's going to take me a lot more upside just to get my money back. So it's just kind of a tumbling effect. So having a really good understanding of how to withdraw your money, I think, is one of the most important things.
Yeah, Joe, and I think another thing to be aware of in terms of storms ahead is a required minimum distribution. So your IRA money, your 401k money, depending upon your age, now you have to start taking money out at either 73 or 75. So just be aware of that even if you don't necessarily want that income, your taxes will be higher because you'll have more income on your tax return. So just be aware of that.
All right, a lot of things to consider here. We got to take another break, but when we get back, we're going to say bon voyage. We want to make sure that you're all set, wrapped up, ready to go. We'll be right back, folks.
If you're sending out an SOS, download the Cruising into Retirement Guide for free. It's the special offer right now at yourmoneyyourwealth.com, but only for a limited time. Learn the tools and strategies to right your retirement ship. Go to yourmoneyyourwealth.com and download this special offer, the Cruising into Retirement Guide, by this Friday.
Welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner, and the CPA is sitting right over there. That's Big Al. We're on a sea cruise, folks, helping you with your retirement goals. Let's see how you did on that true-false question, folks.
Most Americans understand Social Security distribution strategies to maximize their benefits. I think we got a stat that's one survey said 59% of people don't understand Social Security strategies. I would say it's probably 98% if you really think about it. There's a lot of nuances to this.
If you look at most people, they're going to take it as soon as they can get it. And there's a few reasons for that. I think we're so used to and accustomed to a paycheck, right? And you retire, you want to have some sort of fixed income. So it's like, I'm going to turn on Social Security because, hey, bird in hand is better than a couple in a bush, right? There's a very small percentage, even though with all this information and education, is that if you push your Social Security out to age 70, you get this 8% delayed retirement credit.
Because we're living longer, right? So to have that extra protection can be pretty useful. So if you think about when you can take it, you can start at age 62. You can go all the way to age 70. If you go from 62 to 70, it's about a 76% increase, right? So it's almost, Joe, it's approaching double the benefit.
76, though, it's a pretty big number.
It's a pretty big number.
Encourages people to push out, but I still think they don't.
Yeah, I mean, when we see the stats, it's usually around 2 or 3 or 4% that push it out to age 70, so it's not too many.
All right, stay invested, Al.
Okay, we're on that bon voyage, we're on the cruise, and so here's one of the things you want to do. You want to stay invested. Why? Because that produces better long-term results. So here's the last 10 years ending in 2021. If you invested $100,000 and you just stayed invested in the S&P 500, you'd have about $240,000. Now, if you had gotten out of the market for the best 10 days, you missed the best 10 days, now your amount is about $150,000, and you can see if you missed 20, 30, 40 days you actually lost money. And you're thinking, well, I'm not going to miss the best days. Well, guess what? We often do when we try to time the market, because the best days happen after the market crashes or goes down a certain amount, and people get afraid, they get out of the market, and they miss those best days. So you really want to stay invested to maximize your retirement dollars.
Hey, it's never too late to start as well. Let's say you're 58 years old, you haven't saved anything. From 58 to 59, $60,000 contribution over those couple years. Now the law changed. From 60 to 63, they jacked up that catch-up from 7,500 to 10. So over that time period, now my contributions are up to 130. And then from 64 to 70, it goes back to 7,500, but now it's at 210. If I get a 6% rate of return on all of those contributions in the catch-up by age 70, $617,000.
That's a lot, because we do get this question frequently by people in their 50s or even 60. It's like, I've got nothing, now what? Well, you have to have discipline to be able to save at these levels, and that doesn't even include employer matches, so it could actually be a lot better.
Let's flip the script. During the show, over to the viewers, Big Al.
This is Karen, Minnesota. Are there investments to take advantage of high inflation? Well, Karen, that's a great question. I mean, we generally want you to stay globally invested in stocks, bonds, low-cost type investments. But if you want to pick out certain investments that do better inflation, like Treasury inflated protected securities, TIPS, for example, I-bonds. Some stocks tend to do better with inflation, real estate. But if you go back to it, things go up and down at different times. Basically, you would just want to stay invested.
Yeah, well, if you look over the long term, stocks have outperformed the rate of inflation. Bonds have outperformed the rate of inflation. Gold, precious metals and things like that. It's just staying invested is what the key is over the long term. You're going to outpace, underpace, do things like that. But I think it's, again, really understanding what your goals are, what expected rate of return that you're looking for, and then build that portfolio around it.
So from James in Washington, I'm in my 50s. I want to have more spending flexibility, but I still want to keep my risk high. What are the investment choices for me? What do you think, Joe?
You can't have your cake and eat it too. Again, it's coming up with a strategy to figure out, well, what can you spend and what's an appropriate distribution level for the overall portfolio. Because the problem is let's say you have a portfolio that is down 30%. Okay, so you have $100,000, it's down 30%. Well, most people say, well, if it's down 30%, I need a 30% rate of return, I have my money back. Guess what? The math doesn't work that way. You need a lot higher rate of return just to get your principal back. So if I'm going to lose 30% of the portfolio, that means I'm taking high risk, right? I'm taking more risk in the portfolio to get a higher expected rate of return. So if I'm taking on a lot of risk and I'm trying to take income from the portfolio, and when the market turns on you and that market goes down and you're pulling money out, it's almost impossible to get your money back to where it was. So now you're just burning through your cash that much quicker. Then that's when people make mistakes. They get out, they change their strategy. So it depends on how much money that you have and how much money that you're trying to spend and what your fixed income sources are. But you can't have a high flying portfolio and have it sustainable long term, I think.
Yeah, no question. So it really goes back to planning. Like, what rate of return do you need to accomplish your goals in retirement so that it's sustainable and tax efficient, low fees on your investments. So that's where planning comes into play. And if you do the right planning, then you can cruise right into retirement.
Well, what did we learn? Well, we learned to cruise right into retirement, right, Big Al? So all aboard. You got to plan your trip. You got to figure out where you're going and just make sure that you write it down. There's going to be some weather. You might get a little seasick along the way there, so you got to adjust. You got to figure it out. And then just stay the course, making sure that you have the right strategy. Don't make any rational decisions. You might have to change the course a little bit, but you want to make sure that you do it in a disciplined way. All right, that's it for us. I'm getting on a ship and I'm getting out of here. For Big Al Clopine, I'm Joe Anderson, and we'll see you next time.
The Cruising into Retirement Guide is the special offer right now at YMYW, but only for a limited time. This companion guide to today's episode will show you how to navigate the choppy financial seas, overcome seasickness, and stay the course to your retirement destination. Go to YMYW by this Friday and download the Cruising into Retirement Guide for free.